Just a minute. Yeah, good morning. This is Ravi Kanth Miriyala. Welcome back to our next session, that is Ind AS 109, that is Financial Instruments Quick Revision Part 2. Okay, let us try to complete the entire Ind AS 109 in the second session of 1 hour 15 minutes. Let me try. Right, if there is something left, then I will take one more class. Maximum that would be sufficient to close it. Okay, as you know, it is very big standard. It is not that easy and a small standard, right? Always every student will be facing a problem with this, right? And just before examination, reading this is like a nightmare, obviously, correct? So I hope this revision class will be helpful to the students. Fine, let's give it a try. Yeah, before getting into the details, right, we have a small information. Yes, one is about my classes on CA Final Financial Reporting. Yeah, 100% English batch, which is already completed recently. That is on 15th of November, we have completed the batch. All the lectures, recorded lectures, are available on Unacademy platform. Yeah, students can watch those things and you can learn. And we have covered in this session 100% of ICA material, your RTP questions, previous examination questions, everything is already part and parcel of our discussion. Nothing is left. So that would be more than sufficient, not just for examination. Even once you clear, when you get into the company, that time also this knowledge will be very much useful. That I can give you 100% assurance on that. Okay, right. And one more course which I teach, GFRS, Global Financial Reporting Standards, that is paper 6E, elective paper. That is also around 75 hours of lecture. Here also ICAI and mock test papers, previous examination papers, everything discussion, everything already part of discussion. It is available in Unacademy platform. You can subscribe and you can be part of it, right? And one more information with respect to CA Iconic program. Yes, yeah, Iconic program is for CA Final, especially for CA Final. And in this program, doubt solving session, evaluated test series, and printed books will be available, right? And you can ask questions during the class itself, right? You can raise hand and you can speak to the faculty and they will answer you, right? Yeah, email, I mean doubt solving, that is mentoring program, live mentoring program. It's a good program, and one person will be a mentor to you. He will guide you how to cope it up with the syllabus completion. He will plan for you, customize a plan for you based on your requirements and etc. Yeah, he will be taking care of many things which will be helpful to you. And the next is evaluated test papers. They will send you 3 test papers for each subject. One is once it is 40% of syllabus is completed. Second is when you complete 80% of syllabus. And the third one is when you have completed 100% of syllabus. Then yes, they will be sending you paper. Once you write and give it back to them, then someone is going to evaluate your test papers. They will come out with guidance, feedback on the written, where are you lacking, exactly all those things they will be trying to help you. Fine. Yeah, in addition to that, printed material also will be printed material that also will be available to you. Printed material will also be available to you. Okay, right. Iconic subscription. Yeah, when I say this iconic subscription, this option is available for group 1 as well as group 2 and even for both the groups. Yes, combo groups, it is for both the groups also. This option is available. Use the code YESHASLIVE live, YESHAS live, then you will get some 10% of discount if you use the code. Okay, my dear. Yes, let's get into our subject. Yeah, let us get into our subject. Yeah, we have completed till transaction cost. in our first session of 1 hour 15 minutes. Right, let us try to complete the remaining parts of it. Okay, remaining part of the financial instrument. Yes, see, in accounting for transaction cost, yeah, what is transaction cost? We said that is a brokerage, that is a commission. You understand? It is a brokerage, it is the commission, right? And these are all the things are available. Okay, right. And whatever taxes, anything such kind of, but it does not include my, what it does not include, my dear, it does not include premium, it does not include discount on issue of debentures. Such kind of things will not be part and parcel, right? So transaction cost, how are we supposed to account for? Yeah, simple, ma. Is it related to, correct na question? It is always based on the classification. Yeah, is this yes, accounting for a transaction cost? How have you classified the financial asset or financial liability or equity? Yes, simple. If you have classified it as FVTPL, fine. If you classified it as FVTPL, then it will be charged to P&L as and when you incur. It's like a brokerage, normal brokerage, because your job itself is buying, selling kind of job, right? That's why it will be transferred to profit and loss. It will be transferred to profit and loss as and when you incur it. Okay, yeah. If you say it is FVTOCI or amortized cost method, if it is FVTOCI or amortized cost, okay, right. So under that circumstance, we'll ask you one question: is it financial asset or is it a financial liability? Fine. Yeah, is it a financial asset or is it a financial liability? Got it? Yeah, if it is a financial asset, it will be added to the cost of financial asset. If it is a financial liability, it will be deducted. It will be deducted. Okay, right. That is the basic point. Yeah, means say, what is the point here? Suppose you spent, yes, sir, I spent 100 rupees. I spent 100 rupees. And the transaction cost what you have incurred is equal to 2 rupees. If it is a financial asset, then we'll say your total cost is equal to 102. And suppose you have taken a debt, loan is there. Just a second, I'll be back in a minute. I'm sorry. Yeah, sorry. Deducted from the financial liability. Okay, you have taken a loan of 100. You have taken a loan of 100 and you have incurred some transaction costs. Yeah, this is receipt of money which is positive inflow 100 rupees to you, and you have incurred a transaction cost of 2 rupees. Then you will be recognizing the loan in your balance sheet. You will be recognizing the loan in your balance sheet at 98 rupees. You will be recognizing it. Got it? Right. And now next point is what? If you have incurred transaction cost for an equity instrument, yeah, if it is a transaction cost related to equity instrument, then yes, it should be deducted from the equity. Yeah, when I say deducted from the equity, yes sir, I have paid some money to cash. Yeah, debit what? Debit should be security premium. Yeah, debit should be security premium if you have security premium, or you can keep some other equity, whatever the name you want to keep. Yes, you can keep it, but at any point of time, it should not be charged to profit and loss. It is an equity transaction, my dear. It is a transaction with the owner. Understand? That's why it should not be part and parcel of my profit and loss. Never be. Right? Sir, but it is related to compound financial instrument. You told financial asset, you told financial liability, but if it is related to compound, because compound may you learned sometime before, yeah, it has equity element and correct na, and debt element. Yeah, what do you do if it is a compound financial instrument? Compound financial instrument, we have bifurcated the debt and equity separately. Agree? Correct. So in which ratio you have bifurcated debt and equity? In the same ratio, transaction costs are also supposed to be bifurcated and allocated. In the sense, what is related to correct na? See, suppose this is equal to 80, this is equal to 20. Transaction cost, I have spent 10 rupees. Then E10 should be in the ratio of 8:2. That means 8 rupees here, 2 rupees here, correct na? Yeah, it is from debt. If it is related to debt, it should be deducted from debt. If it is related to equity, should be deducted from equity, right? So you will be accounting it as 72 here, and this is equal to 18. That is what you have to allocate it between equity and liability in the ratio in which financial liability and equity got separated. Financial liability and financial liability and equity got separated in the same ratio. You are supposed to do it. Understand? Right. Next, settlement expenses. Got it? Yeah, settlement expenses. Settlement expenses means when you are paying, suppose, yes, in my book value is equal to 100 rupees, right? I am closing this financial liability or equity, whatever it is. I am closing it, yeah, by paying 105 rupees. That means, haven't I paid 5 rupees excess? Yes. So then what should I do? If it is attributable, if it is a liability, okay, then our difference excess amount you paid 5 rupees will be taken to P&L. Okay, no sir, I paid less. Even then it will be transferred to P&L. Okay, right. Now if it is related to equity, yeah, arrow is irrelevant, you can cut it. Okay, right. If it is related to equity, then it should be reduced from the reserves. Yes, you have to debit. Correct. This is nothing but you have to debit equity, because the minute if I say equity, it is pertaining to owners. A transaction with owner can never be routed through profit and loss. Just remember this blind rule. A transaction with owner can never be routed through P&L. That's the basic matter. Next point. Yeah, we are entering into the main important point, which is recognition and measurement of financial asset and financial liability. Okay, important financial asset and financial liability recognition we are doing now. Yeah, initially, whether it is a financial asset or whether it is a financial liability, it will be recognized at fair market value. Okay, at market value, basically. See, unless until it is, yeah, unless until how many, I mean, see, what do I say? My point is, yeah, see, I'll go to the market, I'll purchase. Correct. I mean, in the share market, I'll purchase one equity from another one, someone. I purchase one Reliance company equity share. And you bought it. It has already happened. The transaction only took place at market. Correct, isn't it? Your transaction took place at market value. Then you don't need to search for another fair market value or something. When are we supposed to bother about fair market value? When the terms and conditions are not as per market. Correct. Suppose you gave a loan to employee. Yeah, market may, if they get a loan, car loan or some other house loan or something, any banker will charge them 8 to 10%. But wherein my company is giving a 2%, 4%, it is giving. Then it is not at market terms. It is not at market terms. Then you are supposed to look at. Then you are supposed to look at the terms and, I mean, what is that? You are supposed to bring it. You are supposed to, correct, you are supposed to bring it to fair market value. Yeah, what is that? It will be for 1 hour 15 minutes. Yeah, it will get over by what's the time? 12:15 we started. Correct, na? 12:15. So 1:30 it will get over, my dear. Yes. Yeah, all financial asset and financial liability will be recognized at fair market value, except trade receivables. Why is trade receivables no? Boss, trade receivables is nothing but, right, when you're recording sales, correct, now when you're recording sales as per Ind AS 115, then automatically debtors is the next number, correct, now debtors is the number, this is obviously same number is going to come as debtors. So that's why even though debtors is a financial asset, which we know, correct, we don't want to determine, correct, now why under 115 we have already determined a transaction price. Yeah, under, right, 115, we have determined already what is the transaction price. Yes, use the same transaction price, at later, correct? No? Obviously, it is already determined. Yep. Next point, right? That is initially I told you. Subsequent measurement. Yes, subsequent measurement obviously will have a detailed discussion. Right. For the time being, it is on the balance sheet date and it is based on the classification. Correct. Na? Whether if it is a financial asset, how do you classify the financial asset? If it is a financial liability, how do you classify your financial liability? Got it? Right. So if it is a financial asset, yes, if it is FVTPL or FVTOCI or amortized cost. FVTPL, FVTOCI or amortized cost. Agree? Right. If it is a financial liability, in simple words, we told like amortized cost model or FVTPL. But actually, every financial liability will be measured at amortized cost only. But there are some exceptions to this basic rule, which we will be discussing in just few minutes. Got it? Right. Chalo. Next point, what we say? Fair market value. Fair market value means which is measured as per Ind AS 113. Yeah, fair market value measurement. We have a separate standard as per that. That means exit price. If I sell, what do I get? That is the number. Fair market value is the transaction price with unrelated party transactions. Yes. And in terms of a contract, not as per the market, then you are supposed to measure. Otherwise, if you are, sir, I am already buying it in the market, then I don't need to bother about the fair market value. Something seriously I don't need to think about it. Correct. Na? Fair market value can be what? Present value of future cash flow. That is discounted cash flows using the market rate. This is important. Yeah, you should use not the coupon. It should be obviously market rate you are supposed to apply. Then that number is also called as fair market value. That is also one of the way to measure fair market value. Okay, right. Difference between, right. Sir. See, transaction may amount, what is happening? I am giving loan to 2 employees. Okay, loans and advance account debit. I will record. Yeah, to cash. Okay, cash. Sir, cash is equal to 1000. I gave it to them. But the fair market value, because I am offering them a loan at 4%, wherein market rate is equal to 8%. Very good. Right. But the fair value, present value of it, if you calculate it, let us say 850 rupees it is coming. Okay, fine. But what about the balancing figure? E 150 balancing figure is there, my dear. Correct, na? E balancing figure 150 rupees is there. What should I do with it? Understand? E balancing figure 150 rupees. Kya karna? Correct, na? Shall I charge it to P&L? Or can I recognize it as an asset? It has some small link with the point. What is that point? Right. Now, how did you measure your, correct? Now, how are your inputs? Your fair market value is equal to 850, you told, na? Is it coming from level 1 of inputs or level 2 or level 3 of input? Yeah, level 1, level 3, you must have understood it in Ind AS 113. Yeah, in Ind AS 113, you must have understood these two words. If it is level 1, means market observable inputs, means we are taking it from the market. Fine. Under that circumstance, it can never be an asset. It should be charged to P&L immediately. That's it. Okay. No, sir, we have calculated. It is not available, sir. Fair market value is not available in the market, sir. Okay. We computed, sir, discounted cash flow. We have applied method. Correct. Na? Discounted cash flow method apply kiya, sir. Not like share value, which is available in the market. I took it and put it here. Yeah, I didn't do it. Okay. Right. So now what is that I should do? Under that circumstance, it can be, correct. Now, does it recognize an asset conditions? Means, is it going to get me future economic benefits? If you say yes, recognize it as an asset. If you say no, it is not a future economic benefit. Okay, then we'll charge it to profit and loss. Then we'll charge it to profit and loss. Getting my point? Yes, that is the simple matter. Fine. Right. Next point. Yes. Now, right. I told you, I mean, if you are measuring it using the level 2 or level 3, then does it satisfy asset condition? Then you recognize the difference as an asset. No, it does not satisfy, then the difference will be transferred to profit and loss. Okay, at few examples I have presented here. Loans given to employees at concessional rate. Yes, as I told you, yes, obviously we are discounting at a, yes, you should apply the market rate, and the difference generally should be transferred to P&L as employee benefit. In one of the questions, recent questions may employee, in the text, answer given by suggested answer, I think RTP, if I am sure, they have created as a prepaid asset, right? See, creating as an asset, no, in my opinion, my personal opinion, I say, no, it won't make sense. Why? Because you have given loan to employee. Is that employee has given you a guarantee that I will stay for, guaranteed I will stay? No, correct? And did he say that extra 1 hour I will work daily because you gave me at a cheaper rate? No way. Correct. Now, when you say no, no way, then how come is an asset? How he was working earlier, in the same fashion he will work. Agree? That's it. So it is an employee benefit. Directly should be charged to P&L. In my opinion, it won't be an asset to be recognized in the balance sheet. That is what I feel. Right. Received interest free. Okay. Or concessional government loan. Yeah, that is a government grant. Correct. Now, you got a government loan. Okay, loan. We received loan. Yeah, we received loan of 10 lakh rupees. We received at 2% or 0% interest. Government gave me the loan. Excellent. Government gave me the loan. Okay, government gave me 2% of loan. Under that circumstance, what do? Yes, under that circumstance, what are you supposed to do? 2%, yes, present value of the loan, you determine it. A gap is there. Na? Gap is nothing but government grant. Right. Now you are supposed to look at a difference amount. What should I do? A difference amount. Yeah. Now first question you should ask, is the loan given for what purpose? Loan is given for what purpose, my dear? First of all, if the loan is given for the purpose of, what do you say? If you say, sir, this loan is given with which I am supposed to purchase a machine, sir, and I should, correct, e loan is attributable to a machine, a fixed asset, depreciable fixed asset. Then e loan amount, either you can deduct difference amount what you got, a difference amount you can deduct it from the cost of the fixed asset, or you can show it as a deferred government grant, like that, which we have already discussed in Ind AS 20 quick revision, which is already available. Okay, done. Next, demand deposits received are made. Yeah, demand deposits in the sense, any day that other party has a right to come back and ask, give me my money, or we have right to go and ask, give me my money. Under that circumstance, you don't need to measure any present value. Whatever the amount you exchange today, the day same amount only fair market value, because any day the other party can come back. We don't need to discount for anything. In case of lease assets, okay, if you have given any security deposit, you have received any security deposit, or you gave a security deposit, then our difference amount will be treated as, our difference amount means present value and actual cash inflows outflows will be treated as prepaid rent. It is prepaid rent or rent received in advance, something like that, depending upon the party. Are you a lessor or you a lessee? Accordingly, we'll be doing it. Okay, right. Next important concept, subsequent. So far we are through with initial measurement. Initial measurement is what we have completed. Okay, let us get into subsequent measurement of it. Yes, subsequent measurement of financial liability. Subsequent measurement of financial liability. Yeah, what do we say? All financial liabilities will be measured at amortized cost. All financial liabilities will be measured at amortized cost. Okay, right, except FVTPL. I told you this is to avoid the mismatch, which is a forceful and irrevocable at the initial recognition itself. You must have done this job, right? Second one, when the financial asset does not qualify for a derecognition. Yeah, if it does not qualify for derecognition means in the balance sheet, the financial asset amount will be continued to hold, and whatever the amount you received it, that will be recognized as a financial liability. E number, correct. Now for this the rules of amortized cost, rules of anything is not applicable. It has a separate deal which we are going to discuss. Okay, yeah. When financial asset cannot be derecognized, but you received some money, what are we supposed to do? Yes, cash account debit, correct. Now if you remember, we have discussed a concept called bills discounting, correct. Now a concept called bill discounting. In case of bills discounting, is that my risks and rewards with respect to asset is over? No, not over. We have involvement with the asset. That's the reason do not derecognize the asset. But banker gave me money, na sir, correct, that will treat as a loan received from the banker. So financial liability will be that is loan, whatever the amount received from the government, banker, will be recognized as a loan. Next, if it is a financial guarantee contract, excellent. If it is a financial guarantee contract, we are going to discuss it separately. Yes, I will explain you in few minutes. Contingent consideration which is payable as per Ind AS 103. Do you remember contingent consideration as per Ind AS 103? Yeah, consideration will be paid by the acquirer depending upon the contingencies. Correct? If you make some profits above 5 crore rupees, if I make profit, then I will give you 1 crore rupees extra money. Otherwise, I will not give you. Correct? This is the contingent consideration is going to be classified. It is discussed under Ind AS 103 very clearly. Okay, yeah. What is that? It is classified as, what is it is classified as? Contingent consideration payable, it will be either financial liability or with either it is equity. Yeah, if it is an equity, no adjustment we are going to make it. If it is a financial liability, we will be remeasuring it at every year end, right, till you settle the contingent liability. And if there is any gain, or if there is any loss, that should be transferred to profit and loss statement. Could you please transfer it off? That's one concept. Okay, amortized cost. Next concept is amortized cost, right? So what are you supposed to do? As we discussed some time before, calculate IRR, apply the IRR. That's all. Okay, right. Now fees, what is that? Yeah, what are you supposed to apply in this amortized cost IRR calculation? Yes, we will be applying the transaction cost. If you are paying any premium or any discount, that also will take into account. Any fees which is integral part of the instrument. Yeah, integral part of the instrument. If it is integral, we will consider. If it is non-integral, we will charge it to profit and loss. Okay, integral in the sense means what? Like incremental in another way. We have incurred this because of, correct, it is directly attributable to arrangement of a financial liability. Please consider. That is origination and fees. Correct? Origination are committed fees. Yeah, because you are giving a commitment, banker is giving a commitment, right? Then you are supposed to consider it. Okay. Next, IRR is computed based on the assumption that cash flows will be received as per the terms. Correct. Your expectation. That's all. Basically, it is supposed to be based on your expectation. See, if you look at from the banker angle, correct? Banker angle. Banker gives a loan to Ravi Kanth. Okay. Yeah. The loan is equal to 20 years loan. Yes. Like Ravi Kanth, they must have given to 1 lakh people. So many loans they have given. Correct. Can you expect that there is an option called for Ravi Kanth, prepayment option? Yeah, Ravi Kanth can pay anytime, repay the money. Yes, we can repay the money back to the company. Correct, not to the bank. Okay, under that circumstance, what will be happening, sir? What will be happening? Very simple, sir, nothing. Right, but I may come back and repay, na? I may not hold the loan for 20 years of time. Possible. So, but how do you know out of 1 lakh such kind of loans, which will be, who will come and repay me earlier, who will come and repay me, who will pay me over the period of 20 years fully? How do you know all these things? You never know. That's why based on your estimations, expectations, first you calculate IRR. Got my point? Right. But suppose if there is a change in estimation, suddenly Ravi Kanth started repaying some money. Okay, then what are you supposed to do? Discount the revised cash flows using the original IRR, old IRR. Once again, you calculate it. Now there will be some small difference between the book value and this revised present value number. That number, transfer it to P&L. That means and at the end of the day, your book value supposed to be revised. Your book value should be supposed to be revised amount. Yeah, revised amount means based on the present value of estimated cash flows. Estimated means revised estimated cash flows, I can say. Revised estimated cash flows, what is the number? Suppose example, you have a old book value is equal to 100. Okay, what about the new book value? New book value with the revised estimation, sir, it has come to 102. Okay, that E2 rupees, you just transfer it to P&L. That is what we are trying to say. That's it. Suppose, sir, if there is a floating rate of instruments, sir. Floating rate means, right now, this loan is not rate, is fixed rate. The rate will be moving up and down based on the RBI. Correct. Now, under that circumstance, what are we supposed to do? Are simple here. Don't need to do IRR. First, IRR only not required. Why, sir? It is a floating rate. Floating rate means already market rate. That's why IRR not required. Okay, sir, but what about transaction cost? I have spent already 20,000 rupees. I spent, no? Yes, sir. 20,000 rupees, best method SLM you follow. Suppose you gave a loan for 5 years. Then 20,000 rupees, right? Initially, when you have paid it, sir, I paid, okay, to cash, 20,000 rupees. Excellent. Done. What about debit? Debit is equal to deferred asset you record. Deferred transaction cost, something you name it, 20,000. 20,000, charge it to profit and loss. Charge it to profit and loss for how long? For the over a period of the loan. That is equal to 5 years. Means 4,000 rupees per annum. It will be transferred to profit and loss. That is what you are supposed to do it. Got it? Yes. Let's get into this. This was asked in the RTP question. Yeah, but it was not asked in the examination so far. But this may come up in the very near future. Yes, should be ready. Yeah. Financial guarantee contract. Financial guarantee contract is a financial liability. First and foremost thing, financial liability. Yeah, financial liability means initially how do you recognize it? Normal way, sir. Normal way means initially it should be at fair market value. That's all. It should be at fair market value. Right. Sir, how do you determine fair market value? Yes, there are two methods which we can, because there is no clear guidance is there on that. Fine. So that way we can think of two methods. One is fair market value. What is the beneficial derived by the guarantee? Suppose, RTP question is based on that only. Suppose, what is that? Without guarantee, you try to understand, without guarantee, they are going to get a loan at 12%. Okay, sir, but if I give a guarantee, they are getting a loan at 10%. That means, isn't it a benefit for the, correct, isn't it a benefit per annum? Per annum is equal to 2%. Correct. Suppose if I say this is a 5-year loan. Excellent. How much is the amount? Let us say 100 lakh rupees is the amount. That means, what is the benefit, my dear? Benefit is equal to 2%, means 2% on 100 lakh is equal to 2 lakh, like that. Isn't it for 5 years? Isn't it a benefit? Obviously. 2 lakh, market rate leke, correct, na present value factor at the market rate, discount it and you will get some number. Correct? Yeah, somewhere, suppose 8 lakh rupees came. 8 lakh rupees say fair market value of FGC. Recognize it at 8 lakh rupees. That is method 1. But practically, my dear friend, in the textbook they will give all this information. Okay, practically you may not get this information from the banker. It's very difficult. If you ask him, give me 2 quotation, with guarantee what rate, without guarantee what rate, he may not give you first that quotation. Understand? That is the problem. Fine. So that's why if you know it very well, fine, please follow method 1. Yeah, in examination they will make information available so we can enjoy with it. correct, but practically they will not give you such information. We can't enjoy with it. Agree? Right. Next. Yeah, next one is what? Right. See, guarantee and all, isn't it banker gives always to you? Can we go and ask for a banker, sir, please give me a bank guarantee, BG? Will they give? Yeah, very well they'll give. But when they are giving you, will they charge you? Obviously, correct. The market is always like 0.5 to 0.75, 0.75% they will be charging. How much are they charging? 0.5 to 0.75% they are charging. So when they are charging you 0.5 to 0.75%, you also take the same amount. Applying the probability adjusted discounted cash flows, you can take market rate, you can just go ahead, correct? Now market rate you can go ahead and you can calculate present value of it. Okay, that is initial recognition. Okay, sir. Next, subsequent recognition means on the balance sheet date, how do you measure it? Yeah, here either amortized amount or provision for loss. Provision for loss. Yeah, whichever is higher, you are supposed to take whichever is higher number. Yeah, you are supposed to take whichever is higher number. Yeah, what is that amortized amount, sir? Very simple. Yes, I will say, yeah, you have got 8 lakh rupees financial liability. Yes, sir. Okay, I will say P&L debit. It is a question mark whether you debit to P&L or something else. That I will discuss here. Here only discussed already. Okay, P&L account debit to financial liability. I will record it at 8.8. Exactly, I'll record. Excellent. Now what are we supposed to do? Are we supposed to transfer it? This is a financial liability, na? Yes. Like amortized cost method will apply 8 plus interest at the market rate will apply. Correct. Are you going to repay anything? Nothing will repay, sir. Correct. Then it is equal to, I mean, nothing in the sense we will be amortizing. Na? Every year 2 will be reduced. Na? 2 you can say. Whatever. 2 you can say. Yes. Present value some other, I mean, closing balance will come some number. This is what amortized number. This is amortized number. Now, what about the provision for loss? Yes. Based on the today market conditions, you should guide me. You should tell me. What is that you should tell me? Is there a loss? Is it expected that other party is going to default? You getting my point? Is it expected that other party is going to default? If you say yes, correct. Na? Okay, what is the probability of default? Sir, I am expecting 2% default. Okay, 2% default chance. Okay, if you default, 100 lakh is the loan amount, I know. But you will be able to recover some money from that man, no? Yes, sir, I can recover, sir. How much you can recover? Easily I can recover 80 lakh. That means there is a loss is equal to how much? 20 lakh loss. Okay. That means what do you say? 20 into 2%. 20 lakh into 2%. That means you can say 40,000 rupees or 4,000 rupees, whatever comes. Correct. Now, this will be the amount. Okay. Example, 4 lakh or 40,000 rupees. Yeah, sir, this came amortized cost is equal to 6 lakh. This came 40,000 rupees. It came, sir. I told whichever is higher. Yeah, already book value is 6 lakh. I don't need to do anything. No, sir, E number is more, sir. Then again, P&L expense account debit to financial liability, increase it. Because it is an estimation problem, right? Increase it. Like that, we will be doing accounting. One very good question, which is there in my Ind AS made easy book and which is there in RTP. Okay, both are available in the textbooks. So please look at, may be very important for your upcoming exam. Okay, FGC issued to unrelated party. Okay, then yeah, that is initial recognition. If you have received cash, we'll put that number. Sir, I have not received any money. Then it will be charged to P&L. It will be P&L expense. It will be P&L expense. Agree? Right. Next, it is related to. Why did you? Whom did you give the guarantee? I gave the guarantee to a subsidiary. I gave a guarantee to a subsidiary. Got my point? Right. Now, if the premium received, then cash account debit to financial liability. Yeah. If it is not received, understand? If it is not received, right? Investment in subsidiary account expenses. Correct, na? Yeah. If you have received cash, if you have not received means we did free of cost. Free of cost means for the benefit of my subsidiary only. Correct. That's why investment in subsidiary account, debit to financial liability, you are supposed to record it. Okay. In the books of subsidiary, how do you do it, sir? That depends upon the, is it part of, it is an integral part of the financial debt. Correct now. If you say yes, then we will apply it for amortized cost, IRR purpose we will. Correct now. It is a transaction cost, I will treat it as. Yes, I will treat it as a transaction cost and I will account it. I mean, for the calculation of IRR, I will use it. No, sir, nothing like that. There is nothing, I mean, there is no, then it is you can treat it as a prepaid asset. Correct. And amortize it over the period of loan. That's all. Because subsidiary has given a subsidiary, correct. Now, what is happening here? There is a banker, there is a holding company, there is a subsidiary company. Banker gave a loan. Yes. Holding gave a guarantee to the banker. Correct. What H supposed to record? Financial liability over. What S to record? S got a loan. Correct. Na? But S got freely guarantee. Na? Yeah, because H helped H gave the guarantee to the banker. That's why banker gave me the loan. Correct. So S took 100 lakh rupees of loan. Assuming financial guarantee fair value is equal to 2 lakh rupees. If it is directly integral part of it, then we should say minus 2. Minus 2 is equal to 98. 98 will be your loan amount, like a transaction cost. Understand? Right. If it is not related, then what do you do? E2 will be deferred, will say. Yeah, it will say it is deferred and transfer it to P&L over the period. That's it. It is the way. Fine. Yes. Subsequent measurement of FGC, we already. Is it classified as FVTPL? Yeah, if it is classified as FVTPL, I don't need to say anything. Why? If it is FVTPL, fair value fluctuation automatically will be routed through P&L. Initial also fair value, subsequently also fair value. Fair value in the sense, suppose you have got a doubt that other party will not pay you money. I got a doubt that other party will not pay me money. Then automatically fair value of the liability would have gone up like anything. Yes, it would have gone up. Hope you understand. So this is change in the fair value that would have already been transferred to P&L. Got it? Next. No, sir. No means same thing. Now that is amortized cost and expected loss, whichever is higher. Okay. That is the matter. Right. Now let us enter into one more important point. Subsequent measurement of financial asset. Subsequent measurement of financial asset we are going to discuss. Okay, just give me a few seconds. Yes, my dear. Yeah, now we will start with financial asset. Yeah, financial asset. First we will ask, is it an Is it an equity instrument? Yeah, one small diagram. With this diagram, classification is already we have done that exactly. Okay, everything classification will work out. Is it an equity instrument? If you say yes. Now, do you want to designate as FVTOCI? If you say yes, means FVTOCI. That's all. No, sir, I don't want to designate, sir. Then it is FVTPL. That's all. Finish matter. Okay, equity instrument. If you say no, sir, correct, na? Yeah. If you say no in the sense it is not a FVT, correct? It is not an equity instrument. That means it is a debt instrument. Right. Debt instrument means, right, first we'll ask, do you satisfy SPPA test? SPPA test means whatever the cash comes, is that cash in the nature of principal and payment of interest? Is it in the nature of principal? Is it in the nature of principal and interest? Is it in the nature of principal and interest? First question. Is it in the nature of principal and interest? Hope you got it. Right. If you say yes, it satisfies, correct, na? Yeah, it is satisfying. Yes is missing here. It is in the nature of principal. So no sir, there is no principal and interest in AS. Something extra is there. Oh, something extra is there means it is other than principal and payment. Yeah, say example, convertible debenture. Convertible debenture. Yeah, what do you get? What your returns are? Is it only for the debenture? No, because the debenture is carrying a conversion option. Because the debenture is carrying a conversion option, you are getting the returns from the debenture as well as the equity returns also you are getting. That's why the cash flows are not just merely for the purpose of debt, pure debt. No, it is not just a debt. It has some other element in it. Yes sir, true. Under that circumstance, it is FVTPL. Done. Next. No, so it is satisfying SBPI test. Then we'll ask you the next question. Why are you holding for? Yeah, if you say sir, I am holding it to collect the I want to get the contractual cash flows throughout the maturity. Till the maturity I want to enjoy the cash flows. Oh, is it? Then you follow amortized cost, my dear. Perfect. Okay. Sir, no sir, I don't want. Yes, I want to get the contractual cash flows. Suppose the instrument is for 5 years. I want to get the contractual cash flows for 3 years. And at the end of the 3rd year, I just want to sell it off, make some capital gain. Got it? Yeah. If you say so, that means then you classify it as FVTOCI. Then it should be routed through OCI. Now, if you say, no sir, other business model. What is your business model? Sir, my business model means, okay, business model means nothing great, sir. I mean, other than this, I mean, whenever I want to get, that is for trading purpose, I will say. What purpose I will say? Trading purpose, I will say. Means, what do you mean by trading purpose? Today I hold, tomorrow good price, sell it off. That's all. Do you have any business plan? Kuch nahi hai. Plan is only one, sir. Making profit, sir. That's all. Okay, na? It's not that I have a plan. I need money after 5 years. That's why I am saving here. No such kind of thing. My plan is only making profit. Then it is trading purpose. Then you please put it as FVTPL classification. You should do it. Small diagram. Everything is explained. Okay. It's good actually. Next, points. Yeah. Business model is a matter of fact, not mere assertions. Correct. Now, what is your business plan? Strategy. What is your business strategy? You need to understand. It is not assumption. It is not my intention. Sorry, don't use the word intention. That is wrong word to use. Next, it is a part of investment strategy document. Yes, it is as part of. It is not performed on the instrument by instrument. Yeah, you can do it, some portfolio kind of thing you can do it, and you can do on that. That's sufficient. It is a convertible debt. I told you, FVTPL. It is return based on market index, share market index based. That means it is not pure debt. Correct? It is not pure debt. The returns are based on the market performance as well. That's why we will classify it as FVTPL. Okay, right. Sir, it is a floating rate of debenture. Yes, it satisfies SPPL. Right, it can be anything. In simple thing, a debt instrument can be amortized cost. A debt instrument can be FVTOCI. A debt instrument can be FVTPL. Okay, debt instrument. No, sir, it is equity instrument. Equity instrument cannot be amortized cost. Why? Because there are no contractual cash flows and it does not satisfy SPPI test. Right. And here also there is no contractual cash flows. It does not satisfy SPPI test. That's why it is, yeah, it satisfies only FVTPL. Equity. Correct now. Even derivative. Derivative may, do you know how much money you will get? How do I know? The value will be moving based on something. Right. So no contractual cash flows. It is supposed to satisfy only FVTPL will fit here. Only FVTPL only fit here. Nothing else will fit under this. Got my point? Done. Now, derivative is always FVTPL. That's why we told. Correct? Yeah. Now, income from financial instrument. Correct. If you get dividend income, as usual, my dear, which you learned in accounting standard 9, What is that you learned in accounting standard 9? Financial, what is that? Dividend. When should I recognize dividend? Recognize the dividend when the right to receive is established. Yeah, bola? Right to receive is established. Yeah, record right to receive is established. When probable inflow is correct. Now, obviously, this normal thing, when it is probable and it can be measured reliably, these words will normally it will come. Okay, na? Interest, sir. My dear, interest, whether it is an interest income or interest expenditure. Okay, na? Kya bola? Whether it is interest income or interest expenditure, always only one rate, which is IRR, effective rate of interest. Effective rate of interest, that is only amortized cost method, irrespective of the classification. Sir, I have classified it as FET OCI. Arey boss, FET OCI is for what? You know, for the fair value fluctuation, it should go here and there, correct? Na? But not for what? Not for the interest expenditure, interest income. Next, if there is any gain or loss, yes, on the disposal, gain or loss will go to profit and loss. Okay, but again, if it is a financial asset, if it is classified as FET OCI, the gain or loss will not go to P&L, my dear. That will go to OCI only. That will go to OCI if it was classified. The point is missed out here, but yes, try to understand that. Next, treasury shares. This concept is not applicable to India, but a small concept. That's why I'm just teaching you small thing. What is a treasury share? Yeah, treasury share means we purchased our own shares. Okay, we bought our own. Correct. It's not possible for Indian. We bought our own shares. Okay, our own shares. Yeah, why did you buy, sir? It's not possible in India. It is possible outside India very much. In America, it is very much possible. Okay. Done. Sir, what is this concept? Why is that you are purchasing your own shares? Suppose, my dear, employees ko ESOPs I have given. I promised them. What I promised? Arey boss, all of you together, 1000 shares I am going to give it to you. Either at free of cost or at a cheaper rate. Some rate I must have fixed already. Okay, excellent, sir. But, right, now what is the company supposed to do? We are supposed to issue shares. Correct. Means there are two ways. One is fresh issue you can do. Fresh issue you can do. Correct. A fresh you can issue. Or the second point is what? You can buy it in the market. No, we can buy it in the market. Our own shares. Yeah, suppose there are some employees are there within 3 years time. No? Within 3 years time, I must have given a service condition saying 3 years you have to work. Within 3 years, what I will do, whenever my share market may value of the share comes down suddenly, then go and pick some shares, 500, 200, 1000, something like that. You ensure that you purchase 1000 shares. When these guys satisfy the service condition, I already bought my shares, right? Give it to them. Either a fresh issue you can do, or you can do this job. That's up to you. Right? But in India, you have to do only fresh issue. You can't buy your own shares in the market. Right. So if the law permits to you, that is, you can buy your own shares. That shares what you bought is called treasury shares. Correct, sir? But what should I do with it? What should I do? You cannot hold your own shares. That's why you reduce it from the equity. Balance sheet aisa hai na? Balance sheet mein equity. Equity how much, sir? 10 lakh. Minus treasury shares. How many shares you bought? I bought 10% of it already, sir. Okay, then 9 lakh only will be presented. Right. On this 1 lakh, obviously we will not get any dividend. Correct? Dividend, anything will not come back. No. If you want, you can cancel it. You can reissue it. That's up to you. Agree? Right. You can reissue. You can cancel it. That's purely allowed by the. It is allowed by the Act. It should be. But again, it should not be a dividend. Anything. A gain or loss on that should not be routed through P&L. You should hit security premium or other reserves. Security premium or other reserves account it is supposed to hit, but it should not hit profit and loss at any cost. At any cost. Clear? Done. That's what. Any gain or loss that should be always debited to equity, but it should not to profit and loss. That is what we have told you. Fine, my dear. Yes. See, derivative accounting. Yeah, derivative accounting. See, when I say derivative accounting, right, there is a forward contract, there is a future contract, there is option contract. Okay, excellent. Forward, futures, correct now. Futures, option contract. These things you already very well aware of it. Correct now. You can please run through this. That would be sufficient actually. We don't need to spend. I mean, these are the characteristics, or I can say features. We have written already. It's a features. Feature of forward, feature of future, feature of options are given here. Okay, done. Next, see interest rate swaps. Yes, interest rate swaps are derivative. It will be always classified as FVTPL. Yes, we will be recognizing at fair value on the balance sheet date. Done. Now let's get into we are left with three concepts more. One is reclassification, and next is derecognition, and the last one is impairment of assets. Hedging I will not discuss. If you want hedging detailed discussion, some 3 hours discussion is available in my channel that you can look at. But here it's because from hedging, actually speaking, no question has been asked so far in financial reporting so far. There are 1 or 2 questions have been asked in GFRS. Okay, so you can refer that, but here it's waste of time I feel. Okay, right. But if you are very much interested, please, I told you there is availability, you can watch it. That is sufficient. Reclassification of financial asset. You reclassify means reclassification means what? Change in classification. That's all. Correct. Reclassification means change in classification. Okay, sir. We are doing change in classification. Why are you doing it? Why are you doing means there is a change in the business model. Reclassify when the business model is changed. Means, sir, initially I thought my business need will come only after 5 years. That's why I classified it as amortized cost, because the life of the instrument also 5 years. My need also comes after 5 years. That's what I thought. But now what is happening? Now my need is, now our plan is changed. No, at the end of the 3rd year itself, we want to start our business. We need money. So that's the reason we need money. Okay, that's the reason. What are we doing now? Yes, we are investing. Correct. Now we will withdraw this money. That means now our plan is not to hold till the maturity. Okay, not to hold till the maturity. We want to sell it off and book capital gain or loss also after receiving 3 years of interest contractual cash flows as usual. Then there is a change. Correct. So as you know, first of all, it is FVTPL is one classification, FVTOCI is another classification, amortized cost is another classification. Correct na? Right. So 3 are there. One can go to other 2. Correct na? Amortized cost. Getting my point? Or FVTOCI it can go. Yeah, FVTOCI hai to correct na? If it is FVTOCI, what will happen? 1 second. Yeah, if it is FVTOCI, it may be classified as what? It will be classified as, my dear. Yeah, it will be classified as amortized cost, or it can be classified as FVTPL. Agree? Right. It can be classified as FVT anything. Amortized cost will go to FVTPL, it can go, or FVTOCI, it can go. Correct. The maximum possibilities are that much only. Right. So under each possibility, I have given accounting. Yeah, look at one by one. Easy, another 2 minutes maximum, that would be sufficient. Okay, right. It was amortized cost so far. Now you want to follow FVTPL. Remember one thing. In the new, you are changing the classification. The new classification should be at fair market value. It should be at fair market value only. Okay. Sir, my old book value is equal to 100, sir. But now it has become 120 fair market value, sir. How is it? Our 20, our difference 20, E20 difference should be transferred to P&L. Fine. Financial asset, na? This is financial asset. Financial asset account debit to P&L. 20, you transfer it. Matter over. Next, you should measure it on the classification day. That's what I told you, 120. So now onwards it is book value is equal to 120 ho gaya. It is FVTPL new classification. Any fluctuation gain up and down, that obviously will be routed through P&L from the date of reclassification. From the date of reclassification, any up and down, transfer it to P&L. Clear? Done. Next. Sir, it was amortized cost, but I am doing it FVT OCI. Okay, same sir. This is 100, this is equal to 120. It is going to be 120 na? I mean FET OCI, right? Our difference should be transferred to OCI. Yes, now onwards any fluctuation gain or loss, that will be routed through OCI. Very simple, right? Do you remember one point? Sir, it is a debt instrument. Next, remember carefully here. Reclassification is for only financial asset. Obviously financial liability ko chance hai not there. Why not there such chance? Are financial liabilities all should be amortized cost, subject to FVTPL some concept. Yeah, you can go, you went to FVTPL means it is irrevocable option. I told you already, irrevocable. Once you go to FVTPL, there is no way to return. Okay, right? Return, coming back, no choice. Right. So once you have gone to FVTPL, you should be there. That means reclassification chance is not there. Got it? That is first important point. Right. Next point, what do we say? Next point, reclassification, is it applicable for equity instrument, equity asset, financial asset ko? Not applicable. Why, sir? Equity instrument is always going to be classified as a FVTPL. Even though forcefully if you bring it to FVT OCI, again you can bring it, but you cannot take back, because this is also irrevocable option. It is also irrevocable option. It should be mentioned initially. Hope you understand. That's what. Yeah. So there is no reclassification for financial liability. Correct na? E reclassification concept entirely applicable only for debt instrument. That's what I told you sometime before. Only debt can fit under three situations: amortized cost, FET OCI, FETPL. Equity cannot fit under these, all the three circumstances, impossible to fit. Got it? Done. Next. So remember, that's what. So whatever you apply, sir, whether it is FET OCI, it is a debt instrument, or whether it is amortized cost, but interest is supposed to be using the interest. How do you calculate interest, sir? Interest is always effective rate of interest, IRR calculation only. Amortized cost only should follow. That is the reason we are telling interest is always at effective rate of interest, right? Now you take this 120. What should I take, sir? 120. Take this 120 as what? This is the new cost. Yeah, not new cost. See, under amortized cost, what were you following? Effective rate of interest only. Yeah, the same concept of effective rate of interest, you follow it in FET OCI also. That's all. No new thing. What is new? Now fair value change also will be accounted for. That's only the new. Fair value change also will be accounted for. Right? Otherwise, both are one and the same. Okay. Next. FETPL. Old is FETPL. Now you are bringing to amortized cost. Correct. Under FETPL, you must have not followed effective rate of interest. You might have not followed because it is not necessary. Under FETPL, because fair value fluctuation also comes to P&L, interest also comes to P&L. End of the day, both are falling in P&L. Na? So it doesn't matter whether you put interest using the coupon rate, whether you put interest using the effective rate of interest, it just doesn't matter because both are transferred to P&L. So in FETPL, if you are classified the debt instrument as FETPL, you can follow coupon rate, 100% accepted. Done. But you are getting into amortized cost, na? That means from now onwards, am I supposed to follow? From now onwards, am I supposed to follow? What do you call? Effective rate of interest? Yes, you should follow effective rate of interest. That's the reason. Compute effective rate of interest and follow the same. Right. Today fair market value is equal to 120, I told. Yeah, assume that You should assume that. What you should assume? FVTPL asset is sold now, today. Okay, sir. Amortized cost asset, you bought it afresh. Oh, today I bought it. Today you bought it means you will be buying today at what rate? 120 only. Correct. The market value is equal to 120 means I will buy at 120 only. How can it be a different number? Obviously. So now using 120, calculate your IRR. Calculate your IRR. That's all. IRR you are supposed to follow. Effective rate of interest purpose. Okay. Done. Next. Sir, it is FVTPL, FVT, It was FVTPL, now you are transferring to FVT, See, this is already measured at fair value. This is also already measured at fair value. So no problem. Now onwards, any change in the fair value, that alone should be transferred to OCI. Correct? Now, anyhow, FVT, also you have to follow effective rate of interest. Amortized also you have to follow effective rate of interest. How we calculated? Same thing. You have to determine effective rate of interest. You have to determine effective rate of interest. My dear, you have to determine effective rate of interest and you are supposed to follow the same thing. That's it. Right? Next. FVT, OCI, FVT, PL. It was FVT, OCI. Now you are transferring it to FVT, PL. Reclassification. Yes. Now onwards, any change will come. Transfer to P&L. Okay. Right. Accumulated OCI, whatever is there, that you transfer it to P&L. Because it is a reclassification adjustment. Why? It is a debt instrument. Debt instrument which was classified as FVT, OCI earlier. What is classified? Debt instrument which is classified as OCI. Yes. A gain or loss on disposal, that should be transferred to P&L. What is this? Reclassification adjustment account. Adjustment we call. Simple words. Done. That FVT, OCI is the old classification, sir, and it has been transferred to amortized cost now. Okay, it has been transferred to which cost? Amortized cost ko we have transferred it. Excellent. So now what do you say? We'll measure it at OCI. Yeah, and here what do I do now? You know, first point, if it is FVT, OCI means what you will do now? This is a financial asset. First, you will follow amortized cost. Sir, it is FVT, OCI. FVT, OCI. As if FVT, OCI is not applicable. As if FVT, OCI is not applicable. First, you will calculate the interest as per IRR. Okay. IRR, your amortization table you should apply. Okay, sir. Sir, I got 109 rupees. I got it. Excellent. This is the book value. This is the book value as per the amortized cost method. This is the book value, amortized cost method. Okay. Then what about the fair market value? What about fair market value? Fair market value is equal to 115. Correct? Then what we will do for this? Plus 6 here. IFR, investment fluctuation reserve, 6 more. That's all. Here 6, Mudar 6. That is what I will do when I am following FVT, OCI. When I am following FVT, OCI, I will do like this. Hope you following. Now you want to go back to amortized method. Amortized method means what you will do? E6 cut karo na. That's all. It will, anyhow you are first you are measuring the financial asset as if you are following amortized cost only na. So once you reverse it, things will become quite perfect. Means what are you supposed to do? So IFR is a credit balance, so debit it. IFR account debit 6. So 2 financial asset. Correct na 6. That's it. This is what we will follow. Very simple. Rest of the things are normal. Measure it at fair value. Yeah, obviously we'll measure it at fair value. Okay. That is about reclassification. That is about what? Reclassification of financial assets. Yeah. Next, this offsetting means yes, if it is legally enforceable, you have a right to legally enforceable right to offset it. Otherwise, don't do it. Right. Intends either to settle or realize in net. Legally permitted, and is it our intention also to settle it? Correct. You have to pay me something, I have to pay you something. Yeah, sir, why you will give me, I will give. Correct. You have to pay me 100, I have to pay you 120. right? So I will pay 20 rupees net settlement. Yeah, if that intention to settle it in net, legally if it is permitted, please set off. No, why do you want to show separately? I will show in my books, payable to so and so 20 rupees. Net settlement, net presentation, you can do it. Right. Next concept is derecognition of financial asset. Which one I said? Derecognition. Yeah. Derecognition. Derecognition means what? Derecognition means removal from the books. Removal from books. Removal from books of account. Yes, you are removing it from the books of account. Now the question should come: are you removing part of the financial asset or full asset? Or full assets, sir. Then it's okay, right? What is that? When you say part means, right? It's not exactly full asset. It is no derecognition actually. No derecognition. No derecognition. No derecognition means you have to continue with the financial asset. Yeah, continue with financial asset. Means recognition. It has to continue. You already recognized. I know. Same number, same amount should continue. Right. That is a small correction. Yeah. Only any one of the three conditions satisfy. Yeah. What are the three conditions? First one. Right. When do you say it's a part? What are you selling? Specifically identified cash flows must be there. Like I'm selling only interest strip. Okay. Or I'm selling only principal strip. Agree? Yeah. Only interest strip, only principal strip I am selling. Fine. Under that are two. A proportionate to entire outflow means what? Sir, I am selling you debenture. Okay. Sir, whatever money comes from the debenture, either interest, principal, whatever the name you call, any number comes from debenture, sir. Okay. Into that 70% or 80% is yours. 80% is yours. 20% I will keep it. Fine. This is, I say, part derecognition. Okay, right. Next, proportionate to the identified cash flows. Proportionate to the identified cash flows. In the sense, what? Sir, there is the interest strip is there, sir. There is a principal strip is there. Within the interest strip, 80% is yours, 20% is mine. Within the principal strip, 30% is yours, 70% is mine. There should be clarity, my dear. What amount comes? What is yours, what is mine? Then I say I can derecognize to that part element. You understand my point? Okay, so if you don't say that, if there is no clarity about specifically identified cash flows ka number, which is yours, which is mine, classification is not there. But we entered in agreement. As per the agreement, we got money. Cash I got it, sir. Oh, super, here you got cash. Excellent, my dear. What you got cash? Na? That is called as financial liability, my dear friend. There's a loan we should recognize as a liability. Okay, right. We call it as a financial liability. It is not derecognition of financial asset. Agree? Right. So, yes, sir. That is one point. Next. Yeah. The point is, are you derecognizing financial asset? Yes. I am derecognizing entire financial asset. I am derecognizing. Excellent. Then calculate gain or loss. No. Yeah, correct. Then you calculate gain or loss. How do you calculate gain or loss? Yes, you say profit or loss to profit, and the gain or loss, whatever comes, that will be transferred to P&L. Perfect. But remember, in this derecognition is a financial asset, but if financial asset FET OCI hai to, that is equity instrument which is classified as FET OCI. Understand? If it is financial asset, equity instrument which is okay under that circumstance, what do you say? What do you say, my dear? Yes, it will not go to profit and loss. That automatically should go to OCI because it is an equity instrument classified as FET OCI. This is forceful job, correct? Forceful classification. One time, irrevocable option. Yeah, it should be not going to P&L. It should go to OCI. That you please remember. Okay, right. Net consideration, whatever you got minus carrying amount will do it. That's all. Next, sir, what about part, sir? it is a part of a larger financial asset. One big financial asset means some part is only sold to other party. Okay, only some part is sold to other party. Okay, excellent. Then what am I supposed to do? Yeah, you received some money. Yes, sir. E money, how much you received? I mean, because I sold, na, I got 100 rupees. 100 rupees, 100 rupees ko, sorry, not received. 100 rupees ko, okay. Right. What is the book value? Book value is equal to, sir, 80 rupees is there. E 80 rupees book value bifurcate into two parts. What? Yeah. What is the retention portion or sold portion? Yeah. How do I bifurcate it, sir? Bifurcate it based on the relative fair market values, based on the relative fair market values on the date of derecognition. Based on the, correct, na? Today you are selling. Today only you are supposed to bifurcate retention part and sold part. You have to, book value is supposed to be bifurcated in the ratio of fair market value. Retention portion ka fair market value is how much, sold part ka fair market value is how much. Bifurcate it. Once you bifurcate it, you sold it. This is the book value. Suppose 80 may, suppose say example 60 came. You sold it for 100. 100 minus 60, that comes to 40. If 40 will be transferred to profit and loss. That's all. 40 will be transferred to profit and loss. This is the simple thing. Still we are left with, we are left with how many slides? Let me have a look at it. Extinguishment of liability, impairment, 3-stage model is there. Okay, let me try to have one more class of for half an hour or 45 minutes. Okay, part 3, let me make one more class so that I'll be able to clear derecognition of financial liability, impairment loss, and hedge accounting also light, at least to the extent time permits, I'll do it. Yeah, let me see, let me speak to them. If it works out, fine. Otherwise, the remaining part is also not very big, which you also can try to read and understand it. Thank you very much and wish you all the very best for